I spent decades cracking codes that seemed impossible to break, first for the NSA, then in the markets. And if there's one thing I learned, it's this: when the smartest money in the room starts moving in the same direction, you need to pay attention. Right now, something unprecedented is happening. Billionaires and major institutions are quietly shifting 60 to 80% of their portfolios into cash. Not stocks, not real estate, cash. And most people have no idea why. When you see billionaires and major institutional investors quietly shifting 60 to 80% of their portfolios into cash positions, your first instinct might be to dismiss it as excessive caution or market timing gone wrong. But that would be a critical mistake. These aren't nervous amateurs panic, selling at the first sign of trouble. These are the most sophisticated investors in the world, people who have access to research teams, economic models, and data analytics that most of us can only dream about. They're not reacting emotionally to headlines or getting spooked by market volatility. They're making calculated, strategic decisions based on comprehensive analysis of risk and reward ratios that have deteriorated significantly. What makes this movement particularly noteworthy is the percentage we're talking about. This isn't 5 or 10% sitting in cash as a normal buffer. 60 to 80% represents a fundamental shift in portfolio positioning. It means these investors have looked at the current landscape and concluded that the risk of staying fully invested far outweighs the potential for additional gains. Think about what that really means. These are people who made their fortunes by being invested, by taking calculated risks, by seeing opportunities others missed. They're not philosophically opposed to market participation. But right now, they're choosing to sit on the sidelines in unprecedented numbers. The key distinction here is between fear-based decisions and some strategic positioning. When retail investors panic and sell everything, that's emotion-driving behavior. They're reacting to losses, to scary news, to the feeling of watching their wealth evaporate. But when billionaires move to cash before the crisis hits, that's something entirely different. That's pattern recognition. That's experience informing strategy. That's cold, hard analysis telling them that the math doesn't support current valuations and that protection of capital should be the priority right now. They've studied every major market cycle of the past century. They know what extreme valuations look like. They know what happens when central banks shift policy. They know what consumer debt levels and corporate earnings trajectories signal about future returns. Consider who we're talking about here. Ray Dalio, who built Bridgewater into the world's largest hedge fund by understanding economic cycles and debt dynamics. Warren Buffett, whose Berkshire Hathaway is sitting on record cash reserves exceeding $150 billion. Carl Icahn, who's reduced his market exposure to levels not seen in decades. These aren't people who got lucky once. These are generational investors with track records spanning 40, 50, even 60 years. They've navigated multiple crashes, multiple bull markets, multiple paradigm shifts in how markets operate. And they're all doing the same thing right now. What's particularly telling is the quiet nature of this shift. You won't see press releases announcing these moves. You won't see billionaires going on financial television bragging about how much cash they're holding. This information emerges through regulatory filings, through careful analysis of institutional holdings, through conversations in elite investment circles. The smart money doesn't advertise its positioning because that would defeat the purpose. If everyone knew they were exiting, it would trigger the very correction they're trying to avoid being caught in. So they move slowly, methodically, repositioning their portfolios over quarters rather than days, building their cash reserves without creating panic or moving markets against themselves. This pattern of behavior tells us something crucial about where we are in the market cycle. Throughout history, institutional investors and billionaires have demonstrated an uncanny ability to position themselves ahead of major market inflection points. They were reducing exposure before the dot-com crash. They were building cash reserves before the financial crisis of 2008. They were cautious before Black Monday in 1987. Not because they could predict the exact timing or trigger, but because they could read the mathematical signals that valuations had become unsustainable and risk-reward ratios had turned decidedly negative. When we talk about market valuations being at historic extremes, we're not making subjective judgments or expressing opinions about whether stocks feel expensive. We're talking about cold, hard mathematical measurements that can be compared across decades of market history. The S&P 500's price to earnings ratio, which measures how much investors are paying for each dollar of corporate earnings, has reached levels that we've only seen a handful of times in the past century. And every single time valuations reached these heights, significant corrections followed. Not sometimes, not occasionally, every single time. To put this in perspective, during the dot-com bubble of the late 90s, investors became irrationally exuberant about technology stocks, driving valuations to absurd levels based on hope and speculation rather than actual profits. Companies with no earnings were valued in the billions. The Shiller P/E ratio, which smooths out earnings over 10 years to account for business cycles, reached levels above 40. Today, we're approaching those same extreme territory numbers, but this time it's not just technology stocks, it's the entire market. We have companies across every sector trading at multiples that would have been considered laughable just 15 years ago. The difference is that back then, everyone knew it was a bubble. Today, people have convinced themselves that these valuations are justified by low interest rates, by technological innovation, by a new paradigm in corporate profitability. But here's what the mathematics tell us without any ambiguity. Stock prices have grown far faster than the underlying earnings that support those prices. Corporate revenues are growing at single-digit rates. Profit margins, while still healthy, are showing signs of compression as labor costs rise and pricing power diminishes. Yet stock prices have continued climbing as if none of these fundamental constraints matter. This creates a disconnect between price and value that cannot persist indefinitely. It's not a question of if this gap closes, but when and how violently. What makes current valuations even more concerning is the context in which they exist. During previous periods of high valuations, interest rates were often near zero, making stocks more attractive relative to bonds. Central banks were actively printing money and buying assets, providing a constant bid under markets. Corporate tax rates were being slashed, boosting after-tax earnings. Today, many of those tailwinds have either disappeared or reversed. Interest rates, while down from recent peaks, remain significantly higher than the near-zero rates of the past decade. Central banks have stopped quantitative easing and in many cases are actively reducing their balance sheets. The easy gains from tax cuts and financial engineering have already been realized, yet valuations remain elevated as if all those supportive factors were still in place. The historical data on this is unambiguous and frankly terrifying if you're fully invested right now. When the Shiller P/E ratio exceeds 30, which it does currently, the average 10-year forward return for stocks drops dramatically. We're talking about projected annualized returns in the low single digits or even negative territory. Compare that to the double-digit returns investors have enjoyed over the past decade, and you can see the mathematical problem. Future returns are being pulled forward into the present. Every dollar of gain you see in your portfolio today is essentially borrowed from gains you would have made over the next 5 or 10 years. Look at every major market top in history, and you'll see the same pattern. 1929 before the Great Depression crash, 1968 before the brutal bear market of the 70s, 2000 before the dot-com implosion, 2007 before the financial crisis. In each case, valuations reached extreme levels. Everyone convinced themselves that this time was different, that new paradigms justified higher prices, that old valuation metrics no longer applied. And in each case, reality reasserted itself with devastating consequences for those who stayed fully invested. The mean reversion was swift, brutal, and unavoidable. Stocks trading at 30 times earnings reverted to 15 times earnings or less. Trillions of dollars in paper wealth simply evaporated. There's a pervasive and deeply damaging misconception in modern investing culture that holding cash is somehow a sign of weakness, fear, or ignorance. You'll hear people say that cash is trash, that you're losing to inflation every day you hold it, that real investors are always fully invested and ready to capture every uptick in the market. This mindset has been drilled into an entire generation of investors who've only known bull markets interrupted by brief corrections that were quickly rescued by central bank intervention. But this perspective fundamentally misunderstands what cash actually represents in a sophisticated investment strategy. Cash is not capitulation. Cash is not sitting on the sidelines paralyzed by fear. Cash is the most powerful offensive weapon in your investment arsenal when deployed at the right time. Think about it from a game theory perspective. When you're fully invested, you have no flexibility. You're locked into your positions. If an opportunity emerges, you can't take advantage of it without selling something else, probably at an opportune time. You're essentially playing defense, hoping that what you own continues to go up and praying that nothing goes seriously wrong. That's not a position of strength. That's a position of vulnerability disguised as confidence. Now contrast that with having substantial cash reserves. Suddenly you have optionality. You can wait. You can be patient. You can watch the market gyrate without feeling pressured to act. When panic selling drives quality assets down to absurd prices, you're the buyer. When everyone else is scrambling for liquidity, forced to sell their best holdings to meet margin calls or cover expenses, you're the one providing that liquidity at prices that will look like generational opportunities 5 years later. This is how the truly wealthy build and compound their fortunes. They understand that making money in markets isn't just about being invested. It's about being invested at the right prices. Consider what happened during the financial crisis of 2008 and early 2009. The investors who suffered the most weren't just those who lost 50 or 60% of their portfolio value, though that was certainly painful. The real tragedy was that they had no cash to deploy when blue chip companies were trading at prices not seen in decades. Banks that would recover to become even more dominant were trading for single-digit stock prices. Technology companies with fortress balance sheets and growing revenues were available at valuations that made no logical sense. Real estate investment trusts were yielding double-digit returns. These weren't speculative plays or knife-catching exercises. These were quality assets on sale because everyone needed cash and nobody had it. The investors who emerged from that crisis not just intact, but dramatically wealthier, were those who had maintained cash positions heading into the downturn. They didn't time it perfectly. Nobody does. But they had the dry powder ready to deploy when fear reached its peak. Some of them doubled or tripled their wealth in 18 months, simply by having the resources and courage to buy when blood was in the streets. That's the power of cash. It transforms you from a passive participant, hoping for the best, into an active player who can capitalize on other people's desperation and mistakes. What's particularly important to understand in today's environment is that cash no longer carries the same opportunity cost it did during the zero interest rate era. For over a decade, holding cash meant accepting essentially zero return while inflation slowly eroded your purchasing power. That was a genuine trade-off that made the decision more difficult. But we're not in that world anymore. Short-term treasury bills are yielding 4 to 5%. Money market funds are paying competitive rates. High-yield savings accounts are offering returns that actually keep pace with or exceed inflation. You can hold cash and earn a reasonable return while you wait for better opportunities. This changes the entire calculus of cash versus staying invested. The psychological dimension of holding cash is equally important and often overlooked. When you're fully invested in an overvalued market, every down day feels like a threat. Every piece of negative news triggers anxiety. You're constantly checking your portfolio, second-guessing your positions, vulnerable to making emotional decisions at exactly the wrong time. This emotional toll clouds your judgment and often leads to poor decision-making. But when you're holding substantial cash, you have emotional as well as financial flexibility. Market volatility doesn't frighten you because you're protected. In fact, you start hoping for volatility because it creates the buying opportunities you've been waiting for. The 60 to 80% cash strategy isn't a random number pulled out of thin air or a one-size fits-all prescription that ignores individual circumstances. It's a carefully calculated risk management approach that balances the competing forces of opportunity and protection in an environment where downside risks significantly outweigh upside potential. When sophisticated investors adopt this allocation, they're making a deliberate statement about probability, weighted outcomes based on current market conditions, historical precedents, and mathematical modeling of various scenarios. Let's break down the logic behind keeping 20 to 40% of your portfolio invested, even when you're deeply concerned about valuations. First, there's the acknowledgement that nobody, not even the most sophisticated hedge fund managers with the best algorithms and data, can time market tops with precision. Markets can remain irrational longer than you can remain solvent, as the famous saying goes. By maintaining some market exposure, you're protecting yourself against the scenario where markets continue grinding higher for another 6 months or even a year. You capture some of that upside. You don't feel completely left out. You maintain skin in the game, which is psychologically important for most investors who've spent their lives building wealth through market participation. This partial investment also serves another crucial function. It keeps you connected to market dynamics and sentiment. When you're completely out of the market, sitting entirely in cash, you lose touch with how things are moving, what sectors are showing strength or weakness, where money is flowing. By keeping that 20 to 40% working, you maintain your market intelligence. You're still reading earnings reports, still watching price action, still feeling the pulse of investor psychology. This makes you a much better buyer when the correction finally arrives because you haven't gone completely dormant. Now let's talk about the 60 to 80% that's sitting in cash, because this is where the real strategy lies. This isn't money that you're afraid to invest or that you've given up on. This is ammunition. This is your war chest. This is the capital that will define your financial future when assets go on sale. Think of it like a spring being compressed. The longer you hold this cash and the more severe the eventual correction, the more explosive your returns will be when you deploy it. You're essentially storing potential energy that will be converted to kinetic energy at precisely the moment when most investors are in maximum pain. The mathematics of this approach are compelling when you model different scenarios. Let's say markets go up another 15% from here before correcting 40%. Which is well within historical norms for corrections from extreme valuations. If you're fully invested, you gain that 15%, but then lose 40% of your total portfolio value. Your net result is significantly negative. But if you're following the 60-80% cash strategy, your 20 to 40% invested gains 15%, giving you a 3 to 6% gain on your total portfolio. Then when the 40% correction hits, that invested portion loses 40%, costing you about 2% of your total portfolio. But now you have 60 to 80% in cash to deploy at prices that are 40% cheaper than today. The wealth creation potential in that scenario is enormous. This is why the strategy isn't about market timing in the traditional sense. You're not trying to sell at the exact top and buy at the exact bottom. You're positioning your portfolio so that you win in almost every realistic scenario. If markets go up, you participate somewhat. If markets correct, you're protected and ready to capitalize. The only scenario where you significantly underperform is if markets go up another 50 or 70% from already extreme valuations without any meaningful correction. And the mathematical probability of that happening is extraordinarily low based on every historical precedent we have. What makes this approach particularly powerful is its asymmetric risk-reward profile. Your downside is missing some additional upside in an already extended bull market. Your upside is being positioned to potentially double or triple your wealth when quality assets become available at crisis prices. You're risking modest opportunity costs to gain massive wealth building opportunity. That's not fear or pessimism. That's intelligent capital allocation based on understanding how market cycles work and how wealth is actually created over generations rather than quarters. One of the most dangerous phrases in investing is, "This time is different." It's dangerous because it sounds sophisticated and nuanced, as if the speaker has identified some fundamental shift in how markets or economies function. But when you study market history with any rigor, when you examine the patterns that precede every major crash, you discover something both humbling and terrifying. The signals are always the same. The sequence of events is always remarkably similar. Human nature doesn't change, and because human nature drives markets, the cycles repeat with an almost rhythmic predictability that should make any rational investor pay attention. Every major market peak in recorded history has been preceded by extreme valuations, and we're seeing that today with price to earnings ratios that rival or exceed the most notorious bubbles of the past century. But valuations alone don't trigger crashes. They create vulnerability. What amplifies that vulnerability into crisis is the psychological cocktail that accompanies high valuations. We see it clearly right now. Retail investor euphoria has reached levels not seen since the dot-com boom, with millions of new investors convinced that buying stocks is a guaranteed path to wealth. That corrections are merely opportunities to buy the dip. That risk has somehow been engineered out of the system. This euphoria manifests in measurable ways that historians of market cycles recognize immediately. Record amounts of margin debt, where investors are borrowing money to buy more stocks because their existing positions have made them feel invincible. We saw this before 1929. We saw it before 2000. We saw it before 2008. And we're seeing it again today. When investors are so confident that they're willing to lever up their portfolios, betting that markets will continue rising, they're creating the conditions for a cascade of forced selling when the inevitable reversal begins. Margin calls don't care about your long-term thesis. They demand immediate liquidity, which means selling whatever you can at whatever price you can get. Another hallmark signal flashing red right now is the participation of unsophisticated investors driven by stories rather than fundamentals. During the dot-com bubble, it was day traders quitting their jobs to trade internet stocks they didn't understand. In 2007, it was regular people buying multiple investment properties with no money down, convinced real estate could only go up. Today, it's retail investors piling into meme stocks, cryptocurrencies, and speculative growth companies based on social media hype and fear of missing out. This isn't a moral judgment about these investors. It's a recognition that when the least experienced participants are the most enthusiastic, you're near a top. Market tops are characterized by broad participation. Market bottoms are characterized by capitulation and abandonment. Perhaps the most insidious signal is the narrative that this time is different, which always emerges to justify current valuations and explain why traditional metrics no longer apply. In the 1920s, it was the permanent plateau of prosperity promised by the modern industrial economy. In the 90s, it was the internet creating a new paradigm where profitability didn't matter because growth was all that counted. In 2007, it was the great moderation and the belief that financial engineering had tamed the business cycle. Today, the narratives are more sophisticated, but fundamentally the same. Low interest rates justify higher valuations. Technology companies deserve premium multiples because they're disruptors. Central banks won't let markets fall. Inflation makes stocks a necessary hedge. Each of these arguments contains a kernel of truth, which is what makes them so seductive and dangerous. What history teaches us is that the crash never comes from the direction everyone's watching. Before 2000, everyone worried about Y2K computer problems, not the fundamentally unsustainable valuations of technology stocks. Before 2008, people focused on subprime mortgages being contained, not the systemic leverage and interconnectedness that would bring down the global financial system. The trigger is usually something that seems manageable until it isn't, something that everyone dismissed as unlikely or irrelevant until suddenly it's the only thing that matters. This is why the specific catalyst doesn't matter as much as recognizing the underlying fragility created by extreme valuations, excessive leverage, and widespread complacency. The pattern is so consistent across centuries of market data that ignoring it requires either ignorance of history or a belief that you're somehow smarter than every generation of investors who came before you and convinced themselves that their situation was uniquely different. The financial crisis of 2008 and the subsequent recovery of 2009 stand as one of the most instructive periods in modern market history. Not because of the losses that occurred, though those were certainly devastating for millions of people, but because of the extraordinary wealth creation that happened for those who were positioned correctly. This wasn't luck. This wasn't insider information. This was simply the result of having cash available when everyone else desperately needed it. The lessons from that period are so profound and so relevant to where we are today that every serious investor should study what happened and who profited from it. When Lehman Brothers collapsed in September 2008, it triggered a cascade of selling that became self-reinforcing and relentless. Margin calls forced investors to liquidate positions. Hedge funds faced redemptions and had to raise cash by selling their best holdings, not their worst ones, because the worst ones had no buyers at any price. Money market funds broke the buck, creating panic even in supposedly safe investments. The entire financial system seemed on the verge of collapse. In that environment, stock prices became completely detached from underlying business fundamentals. Companies with strong balance sheets, dominant market positions, and sustainable business models saw their stock prices cut in half, then cut in half again. But here's what separated the winners from the losers during that period. It wasn't intelligence or analytical skill or access to better information. Almost everyone could see that blue chip companies trading at 5 or 6 times earnings were absurdly cheap. The difference was liquidity. The investors who had maintained substantial cash reserves heading into the crisis, who had resisted the temptation to be fully invested during the bull market of 2006 and 2007, suddenly found themselves in a position of extraordinary power. They could buy when everyone else could only sell. They could be patient and selective, waiting for true panic to drive prices to their lowest points, while distressed sellers had to accept whatever bids existed. Consider what happened to someone who had the cash and courage to invest during the darkest months of early 2009. Financial stocks that had been left for dead, banks that were considered potentially insolvent, were available at prices that represented 90% discounts from their previous highs. Companies like Bank of America, J.P. Morgan, Wells Fargo, these weren't speculative ventures or turnaround plays. These were essential components of the American financial system that the government would never allow to fail. Yet you could buy them for single-digit stock prices. Within 18 months, many of these positions had doubled or tripled. Within 5 years, some had increased 5 or 10-fold. That's generational wealth creation compressed into a remarkably short time period. The same pattern played out across every sector of the economy. Technology giants like Apple and Microsoft, companies with fortress balance sheets and growing revenues, saw their stocks trading at valuations that made absolutely no sense from a fundamental perspective. Real estate investment trusts that owned high-quality properties with strong tenants were yielding 15 or 20% simply because the right structure forced them to distribute earnings, and investors were so desperate for cash that they were selling anything that would generate liquidity. Even Treasury bonds, supposedly the safest investment available, were trading at distressed levels as investors dumped everything in a panic. What's particularly important to understand is that the investors who captured these gains didn't need perfect timing. They didn't buy at the exact bottom. Many of them started buying in late 2008, watched their positions drop another 20 or 30%, and kept buying. They understood that when quality assets are trading at irrational prices, you don't wait for confirmation that the bottom is in. You accumulate. You average down. You recognize that you're being paid to take positions that scared investors are abandoning. The margin of safety was so large that being a few months early didn't matter. The returns were extraordinary regardless of whether you bought in October, December, or March. This is the crucial lesson that today's investors need to internalize. The wealth creation didn't happen during the bull market that preceded the crash. Everyone made money during that period, But those gains were modest and incremental. The real wealth, the life-changing wealth, the wealth that allowed people to retire early or fund their children's education or buy properties outright, that wealth was created in the 6 to 12 months after the crash when assets were on sale and only those with cash could participate. Fear of missing out, commonly known as FOMO, might be the single most expensive emotion in investing, yet it's also the most socially acceptable and the hardest to resist. Unlike greed or panic, which investors recognize as dangerous emotions that cloud judgment, FOMO disguises itself as rational behavior. It tells you that you're being smart by staying invested, that you're capturing gains, that you're participating in wealth creation. But what FOMO really does is keep you fully exposed at exactly the moment when risk is highest and potential rewards are lowest. It convinces you to chase the last scraps of a bull market while ignoring the mathematical reality that you're setting yourself up for devastating losses. The psychology of FOMO is particularly powerful during late-stage bull markets because the pain of missing out feels immediate and visceral, while the risk of staying invested feels abstract and distant. Every day the market goes up without you, you can calculate exactly what you missed. You see your neighbor's portfolio growing. You hear stories at dinner parties about people making money in stocks you don't own. You watch financial media celebrating new highs and interviewing investors who stayed fully invested. The social pressure is immense. The feeling that you're being left behind is overwhelming. Meanwhile, the risk of a correction feels hypothetical, something that might happen someday but isn't happening right now, so why worry about it? But here's the brutal mathematical reality that FOMO obscures. Let's say you're facing a decision right now. Markets have already gone up substantially. You could stay fully invested and potentially capture another 10 or 15% if this rally continues for a few more months. Or you could move to a defensive position with substantial cash reserves, accepting that you'll miss that final push higher. FOMO screams at you to stay invested because that 10 or 15% feels significant. Your brain calculates what that means for your portfolio. If you have $1 million invested, that's potentially another $100,000 to $150,000. Missing that feels like a real loss. Now consider the other side of the equation, the side that FOMO conveniently ignores. Historical data shows us with brutal consistency that when markets correct from extreme valuations like we're seeing today, they don't drop 10 or 15%. They drop 40, 50, sometimes 60% or more. If you're fully invested when that happens to your $1 million portfolio, you're not losing a hypothetical $100,000 in gains you might have made. You're losing $400,000 to $600,000 of actual wealth that you've already accumulated. And worse, you have no cash to deploy when the correction creates generational buying opportunities. You're forced to either watch from the sidelines as assets go on sale or sell at depressed prices to raise cash, locking in your losses at the worst possible time. The asymmetry here is staggering, and yet most investors completely miss it because FOMO has hijacked their decision-making process. You're risking enormous real losses to chase modest potential gains. You're betting your financial security on the hope that an already extended market will extend even further, defying both historical precedent and mathematical probability. This isn't investment strategy. This is gambling driven by emotion, specifically the emotion of not wanting to feel left out or left behind. What makes FOMO particularly insidious in today's environment is the amplification effect of social media and constant market coverage. 50 years ago, an investor might check their portfolio monthly or quarterly. They weren't bombarded with real-time updates about what they were missing. Today, you can't escape it. Every uptick is celebrated. Every new high is broadcast. Every winning trade is shared on social media platforms. You're constantly confronted with evidence of what you're supposedly missing out on, which makes the rational decision to move to cash feel nearly impossible despite the mathematical logic supporting it. The investors who build lasting wealth, who preserve and compound their capital across multiple market cycles, are the ones who learn to ignore FOMO completely. They understand that missing the top 10 or 15% of a bubble is not just acceptable, it's desirable. They recognize that the real opportunity isn't squeezing out the last gains from an overextended market. The real opportunity is being positioned with cash when that market inevitably corrects, ready to buy quality assets at prices that will seem absurd in hindsight. For over a decade following the financial crisis, one of the most compelling arguments against holding cash was the opportunity cost it imposed on investors. When short-term interest rates were effectively zero, when savings accounts paid fractions of a percent, when money market funds yielded almost nothing, the mathematical case for holding substantial cash positions was much harder to make. Every dollar sitting in cash was a dollar that earned nothing while inflation slowly eroded its purchasing power. You were essentially paying for the privilege of safety, accepting guaranteed real losses in exchange for liquidity and protection. That trade-off made sense for emergency funds and short-term needs, but it was difficult to justify holding 20, 30, or 40% of a substantial portfolio in cash that generated no return whatsoever. That entire calculus has fundamentally changed, yet many investors are still operating with the mental models and assumptions from the zero-rate era. The Federal Reserve's aggressive rate hiking cycle over the past few years has transformed the cash landscape in ways that dramatically alter the strategic equation. Short-term Treasury bills, which are backed by the full faith and credit of the United States government and are considered among the safest investments available anywhere in the world, are currently yielding 4 to 5%. That's not a trivial return. That's a meaningful real return after inflation that provides both safety and income while you wait for better opportunities in risk assets. Money market funds, which invest in short-term high-quality debt instruments and provide same-day liquidity, are paying competitive rates that would have seemed impossible just 3 years ago. High-yield savings accounts from reputable financial institutions are offering rates that actually keep pace with, or in some cases exceed, current inflation levels. What this means in practical terms is that the opportunity cost of holding cash has been dramatically reduced, or in some cases eliminated entirely. You're no longer sacrificing returns for safety. You're getting both. You can sit in cash, earn a reasonable return, maintain complete liquidity, and wait patiently for the market conditions that favor deployment of that capital into risk assets. This development is particularly significant when you compare cash returns to the risk-adjusted expected returns from stocks at current valuations. If stocks are trading at historically extreme price to earnings ratios and the mathematical projections suggest forward 10-year returns in the low single digits, and you can get 4 to 5% risk free in Treasury bills, the relative value proposition becomes quite clear. Why would you accept the volatility, the sleepless nights, the risk of 40 or 50% drawdowns for the possibility of earning maybe 2 or 3% more annually than what you can get risk-free? The risk-reward ratio doesn't make sense. You're not being adequately compensated for the risk you're taking. Moreover, the current rate environment means that holding cash isn't a binary choice between earning nothing and being fully invested. You have a spectrum of options that allow you to generate income while maintaining varying degrees of liquidity and safety. Short-duration bond funds, certificates of deposit with terms ranging from 3 months to a year, Treasury bills with different maturity dates. These instruments allow you to structure your cash holdings to optimize for both return and accessibility based on your specific timeline and needs. You can ladder your maturities so that portions of your cash become available at regular intervals, giving you both income and flexibility to deploy capital when opportunities arise. The psychological benefit of earning a return on cash cannot be overstated. When your cash position is generating 4 or 5% annually, it's much easier to maintain patience and discipline. You're not watching your portfolio stagnate while the market gyrates. You're actually making money in a safe, predictable, low-stress manner. This reduces the psychological pressure to jump back into risk assets prematurely. It allows you to wait for truly compelling valuations rather than settling for mediocre entry points because you're frustrated with cash sitting idle. The income from your cash holdings validates your defensive positioning and reinforces your ability to stick with the strategy. This represents a fundamental shift in the strategic landscape that too many investors have failed to recognize or adapt to. The arguments against holding cash that were valid from 2009 through 2021 are no longer valid today. The environment has changed, the opportunity set has changed, and your strategy should change accordingly. One of the most dangerous misconceptions that investors hold during late-stage bull markets is the belief that they'll be able to recognize the top and exit before everyone else. They convince themselves that they're paying attention, that they're monitoring their positions, that they'll see the warning signs and act decisively when the time comes. But this represents a fundamental misunderstanding of how market crashes actually unfold. The reality is far more brutal and unforgiving than most people imagine. When the selling begins in earnest, when fear replaces greed as the dominant emotion, the speed and violence of the decline catches even experienced investors completely off guard. Market crashes don't announce themselves politely and give everyone time to make orderly exits. They happen with shocking rapidity, often compressing what would normally be months of gradual decline into days or even hours of panic selling. The morning starts with what looks like a routine pullback, maybe 2 or 3% down, nothing that hasn't happened dozens of times during the bull market. Investors tell themselves it's just another buying opportunity, another chance to buy the dip like they've done successfully so many times before. But then something shifts. Maybe a major financial institution reports unexpected losses. Maybe an economic data point comes in far worse than anticipated. Maybe a geopolitical event creates uncertainty. The specific trigger almost doesn't matter because the underlying fragility was already there, waiting for any catalyst to expose it. What happens next is a cascade that feeds on itself and accelerates with each passing hour. Algorithmic trading systems, which now account for the vast majority of market volume, hit predetermined stop-loss levels and begin automatically selling. This drives prices lower, which triggers more algorithms, which creates more selling pressure. Margin calls start going out to investors who borrowed money to buy stocks, and these aren't polite requests that can be negotiated. They're demands for immediate cash, which means selling whatever positions have buyers, often at any price available. The most liquid positions get sold first, which means the highest quality stocks often fall the fastest initially, creating the paradoxical situation where the best companies see the steepest declines. Retail investors, watching their portfolios crater in real time, overwhelm their brokerage platforms trying to enter sell orders. Trading systems slow down or crash entirely under the volume. Orders that used to execute instantly take minutes or hours, and when they finally do execute, it's at prices far worse than what the investor saw when they hit the sell button. This technical breakdown compounds the panic, because now investors can't even access their accounts or get out of positions, creating a feeling of complete helplessness that drives even more desperate selling when systems come back online. The psychological toll of watching wealth evaporate while being unable to act is devastating and often leads to catastrophic decision-making. Professional money managers face their own version of this nightmare scenario. When their clients start redeeming their investments, demanding their money back, these managers are forced to raise cash by liquidating positions regardless of valuations or their own market outlook. They might personally believe that stocks are cheap and represent buying opportunities, but redemptions don't care about your thesis. You have to meet those cash demands, which means selling into a declining market at terrible prices. This creates another layer of forced selling pressure that has nothing to do with fundamental views and everything to do with structural liquidity needs. The metaphor of the small exit door is not an exaggeration. Imagine a theater with 1,000 people and one narrow doorway. As long as everyone stays calm and seated, that doorway is adequate. But the moment someone yells fire, everyone rushes for that single exit simultaneously. People get trampled. Panic ensues. The crowd becomes its own obstacle. Markets work exactly the same way. During calm periods, liquidity seems abundant because there are buyers and sellers at reasonable price differences. But when everyone wants to sell at once, the buyers disappear entirely. The bid-ask spreads widen from pennies to dollars. Volume dries up except at prices far below where stocks traded just hours earlier. This is why the strategy of waiting to sell until you see clear evidence of a top is fundamentally flawed. By the time the evidence is clear to you, it's clear to everyone else too, and you're all trying to exit through that same small door simultaneously. The investors who preserve their wealth are the ones who exit before the panic starts, who accept missing the final stages of the bull market in exchange for not being caught in the stampede. There's a profound truth about wealth creation that gets obscured during bull markets, a truth that makes many people uncomfortable, but remains mathematically undeniable. The greatest transfers of wealth, the moments when fortunes are truly made and generational financial security is established, don't happen during the good times when everyone is making money and portfolios are rising steadily. They happen during crashes, during periods of maximum fear and dislocation, when assets change hands from weak holders to strong holders at prices that will look absurd just a few years later. This isn't a moral statement or a judgment about fairness. It's simply how markets function as mechanisms for transferring wealth from those who cannot or will not hold through volatility to those who have the resources and temperament to buy when others must sell. During bull markets, wealth creation is broad but shallow. Almost everyone participates to some degree. Your neighbor makes money. Your coworker makes money. The person who just started investing last month makes money. Returns are positive but relatively modest and incremental. You might make 8 or 10 or 12% annually, which compounds nicely over time, but it's not transformational. It's not the stuff of early retirement or generational wealth. It's steady accumulation, which is value, but it's available to everyone who simply stays invested. There's no particular advantage to being smart or disciplined or well capitalized during bull markets because the rising tide lifts all boats indiscriminately. The dynamic changes completely during crashes and the recovery periods that follow them. Suddenly, having capital becomes an enormous advantage because most people don't have it. They're either fully invested and watching their portfolios implode, or they need to raise cash for living expenses or margin calls or redemptions, which means selling at precisely the worst moment. The investors who preserve capital, who maintain substantial cash reserves despite the opportunity cost and the social pressure and the FOMO, suddenly find themselves in a position of extraordinary power. They're the only buyers in a market flooded with desperate sellers. They can be selective, patient, disciplined. They can demand enormous discounts because sellers have no leverage and no alternatives. This wealth transfer is systematic and massive in scale. Studies of every major market crash show that the wealthiest individuals and institutions significantly increased their wealth during and immediately after crisis periods, not because they were engaging in anything nefarious or unfair, but simply because they had capital available when assets were being liquidated at irrational prices. They bought stocks at 5 or 6 times earnings that would return to 15 or 20 times earnings within a few years. They acquired real estate at 40 or 50 cents on the dollar. They purchased corporate bonds yielding double-digit returns from companies that were fundamentally sound but temporarily unable to access normal credit markets. These weren't speculative bets or risky ventures. These were quality assets on sale because the market had temporarily broken down. The mathematics of this wealth transfer are staggering when you model them out. An investor who buys stocks at the bottom of a crash, when prices have fallen 50 or 60% from their highs, doesn't just recover their value when markets return to previous levels. They double their money, and because markets historically overshoot on the upside after major crashes, driven by pent-up demand and renewed optimism, the actual returns are often far greater. This is how people turn hundreds of thousands into millions or millions into tens of millions in compressed time periods. It's not magic. It's not luck. It's the systematic exploitation of forced selling by those who maintain the financial resources to be buyers. What's particularly important to understand is that this wealth transfer is zero, some at the moment of transaction, but positive some over time. When you buy a stock from a distressed seller at $50 that was trading at $100 6 months ago, and will trade at $150 3 years from now, you haven't stolen anything from that seller. They chose to sell perhaps because they had no choice given their financial constraints, but the transaction itself was voluntary. However, you captured wealth that they couldn't or wouldn't hold on to. Over time, as the company grows and prospers, additional wealth is created, but the distribution of that wealth is determined by who owned the assets during the recovery period. The implication of this reality is profound for how you should think about portfolio positioning today. If you're fully invested at elevated valuations, you're positioning yourself to be on the wrong side of the next wealth transfer. You're setting yourself up to be the forced seller, the distressed seller, the person who has to accept whatever price is offered because you need liquidity and you have no alternatives. But if you build substantial cash reserves now, if you accept missing the final stages of this bull market, if you resist FOMO and maintain discipline, you're positioning yourself to be on the right side of that transfer